Hi, it's Lee, and welcome to the Tesla Economist. Tesla want to grow. They intend on doing this with just a few models for the time being. Elon's saying that he expects the Model Y alone to be the best-selling car, despite the higher than average price point. And we're seeing it as the top-selling car in many markets, and often closely behind is the Model 3. There's no denying that Teslas are fantastically popular, and for many reasons that we've gone over at length. Elon has even said that he is embarrassed as to how expensive the Model Y has become. But this was due to controlling demand. It meant that margins and ASPs for the vehicle shot up. And to control demand the other way, Tesla can simply lower the price back down again, and it is still a profitable car with great margins. However, the plan is for Tesla that they don't just want demand to be stable by adjusting the prices. Tesla need demand to continue to grow. Yes, we have the EV industry organically growing and governments backing the movement. More people understanding the benefits and advantages of Teslas and EVs in general. But is that enough to reach the numbers that Tesla are aiming for? Tesla will inevitably need to lower their prices to hit these targets. We know there is a much larger pool of buyers at lower price points. Even a $5,000 lower price point has many more buyers. However, investors are spoilt now. They want these 30% margins. That's why Tesla is such a good investment, because we get these insane margins. When Tesla's stock price was at its highest, it was getting 29% margin on the autos alone, excluding regulatory credits. These prices, though, were before any major price rises had kicked in. Tesla raised prices across the board. So Tesla can lower their prices back down to these numbers and perhaps get around 29% margin again, or if inflation has had some impact, perhaps just 27%. Although we should also factor in improved manufacturing processes that have cut costs. But even if we just say 27%, hang on, that is really high as well. That's what we got last quarter after these price rises are in effect. Yes, but Berlin and Texas were killing the margins, along with Shanghai experiencing lockdowns and line upgrades. But that's what's required to maintain existing demand. We need to increase demand, and we need to increase it by 50% each year with the growth. We don't appear to have the additional buffer we once had on waiting times. Although finding 50% more demand next year than this year isn't as difficult as it sounds, as Q4 annualized actually isn't that far, 50% growth from the entire 2022. We would therefore expect there to be more growth in production than 50% for the whole year. Well, the majority of the additional growth we're going to see next year will obviously come from the two new factories. These factories will be able to produce Model Ys at much lower cost, with lower cost batteries and advanced manufacturing techniques. They can then release this 4680 Model Y at a lower price and still maintain good margins. It may still be the same spec that we saw from Texas already at perhaps $60,000 with 280 miles of range. This would now be a $52,500 car with the tax credit. Tesla would also get a subsidy for the cells for each one too. If Tesla passed on this subsidy to the customer, then Tesla could sell the Model Y from Texas for under $50,000 and still get the equivalent of $60,000 for the sale. Most likely somewhere between 40 and 50% margin, even at that price point. This is a big difference in price from the current Model Y at $66,000, which incidentally also used to sell for under $50,000, and Tesla's stock price was still doing well back then. As for Berlin, there the Model Y should be of more value as it would save the customer more on gas, and Tesla seem to cost more in Europe than the US too in general, so there may be some room to move. It's also made locally, so the cost is somewhat relative. But due to the tax credit in the US, it's likely that the Model Y may not be as profitable in Europe. However, even if the cost of the vehicle does have to get low enough to hit the demand, then we're still going to see 40% margins. Even at around a price of $50,000, we might expect that. So we have growth from lower cost versions of the Model Y that offer longer range and all-wheel drive compared to the standard range versions. So it's possible that even though Tesla may need to lower their prices, their ASPs and margins could still increase and they could still see growth. And even if these prices are still low enough for these new Model Ys, then there is additional margin there if necessary in all markets, and a massive amount of margin in the US due to the credits and subsidies. Then the Model 3, which is still pretty expensive in the US and going to become even more popular with the credits. I don't think there are demand issues so much with the Model 3. The cost is already very low for the rear-wheel drive version, which is the vast majority of Model 3 sales, and they don't make anywhere near as many Model 3s as they do Model Ys. When exported from China, Tesla can sell them for low enough prices and still make an alright margin. But if demand is still dropping despite these low prices, or at least in China, then it's going to be tough to grow further expansion of the Model 3. Which is why Tesla are going to launch this Model 3 Highland. It makes perfect sense. And as I've said, I am so happy to hear about this car, as the Model 3 rear-wheel drive is already at this low price point. Removing a few more $1,000s to an even lower price point has a really large pocket of demand for it. Tesla know how to make lower cost vehicles, front and rear castings and structural battery packs, and many other cost saving techniques too, like removing ultrasonic sensors. For all we know, they may be switching over to four-wheel mechanical braking and remove hydraulics, which complicate manufacturing, as an example. My point is, there are advances in vehicles and manufacturing processes since the current Model 3 that can be implemented to save cost and improve the vehicle. It would just depend on what level they take the manufacturing. This is going to save a lot in cost, and it will also mean that Tesla can produce that many more vehicles in the same factory, further reducing cost again due to the faster production speed. So if it's demand that needs to be sorted in China and the export markets the most, then I would say there's a good chance that the Highland upgrade would first happen in Shanghai, so be prepared for some factory downtime next year possibly. The Model 3 should hopefully get the tax credit in the US anyway, so demand should be stable there too. And once Tesla have sorted out the Highland in Shanghai, then they should have a better idea of how to do it quicker in Fremont and upgrade the Model 3 there. Although if it is a refresh and consumers know that is coming, it might hurt sales, the whole Osborne effect thing. So Tesla may have to drop prices of their Model 3 in the US for the older version until the Highland is available, or perhaps they may have to do the revamp for both Model 3 factories at the same time because of this. Again, output would also increase from Fremont, and I believe they will have sufficient sales coming from the new CATL factory. On top of all this, Tesla are finally getting on with the energy business, which is sounding like it is more profitable than I initially thought. And it also sounds like Tesla are at a much higher rate of production that we would have assumed this early. It would appear that it is much easier to ramp up a Megapack factory than an EV factory. And although Tesla have enough cells for this factory's current alleged capacity, if Tesla made the Model 3 Highland, it would certainly free up a lot more LFP cells if the Highland was now using CATL's structural battery pack M3P cells, which means energy could be massive. China are not stopping with their ramping of cells and batteries, and Tesla still wants as many as they can get. Tesla will find somewhere for all of them. The growth is important. It makes the company more profitable naturally due to the economies of scale. As you can see, Elon runs a very tight ship, something we've noticed with how he is handling Twitter. As a result, Tesla has very low operating expenses, and with all the growth we experience, the OPEX doesn't seem to increase. In fact, it's been decreasing lately. In the past, we've seen operating margins as high as nearly 20%. Now, when you keep OPEX the same as it was, and add more sales of vehicles that have gross margins of 40%, this does a huge amount to operating margin. However, even if Tesla are having to drop prices down to margins of 25% for some of the vehicles, if we see enough growth, then operating margins should still be about 20% too. But we would hope that these new Model Ys and Model 3 Highlands would get us back to gross margins of around 30% again, which would push operating margins perhaps closer to 25%. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.